We're at 388 out of 500 companies in the S&P 500 index that have already reported their fourth quarter earnings. And wow, the numbers look absolutely incredible. Right now, 67% of companies that have reported have already beat analyst estimates for earnings, which is really a tremendous sign. We've talked a lot about large cap stocks and really the value of putting dollars behind them and putting investments into them over these last couple of years. And the numbers continue to support that data. And what's also really important about this data too, with these numbers coming out, is what's the likelihood of a recession? And we talked a lot about recessions and what's the likelihood of them with everything going on in terms of inflation and the Fed managing monetary policy. But we really just aren't seeing any risk of a recession on the horizon because US companies have just been so strong and so resilient and continue to really drive the economy forward. Now, with that in mind, let's change gears a little bit and talk about the Fed monetary policy that I just mentioned. So, Fed Chair Jerome Powell met with Congress last week and gave them a briefing of sort of what is the Fed doing. And he was somewhat mindful to skate around talks and questions of Trump's policy around tariffs because, again, the Fed doesn't really have much to do with tariffs. That's really all limited to what the government's doing on the president's side and maybe what some laws that Congress and the Senate are enacting. The Fed is really controlling more of the inflation side by controlling the supply and demand of dollar flows internally within the country. They really have nothing to do with any policies outside of the country in terms of handling dollars on that front. Again, I'm sort of giving the high level overview of saying that they have nothing to do. Of course, they're involved with money every step of the way as it comes in and out of the country. But in terms of the actual policies and decision making, the Fed is really focused more on controlling what they have direct access to, which is the supply, flow in and flow out of dollars with banks in the U.S. banking and financial system. That is their primary focus. So with that in mind, let's talk a little bit about what Jerome Powell said to Congress. So if you read through the minutes, and again, the minutes are long, so I don't expect anyone to actually go through and read them, but the gist of them is that what I said, of course, at first, right? He sort of skated around the tariff questions, but he did give some indication that the Fed is not in any rush to cut rates. He said there's still a lot of work to do. A lot of the inflation figures that are being reported to them, CPI indexes, everything along those lines are still not in a favorable position for them to say, okay, we're comfortable to continue lowering rates. They still feel like rates are too high above their comfort level. And again, it's all just an indication that they simply are not going to cut rates, which if anyone has really been watching my videos over the last few months, really to start off the year, we've talked about the fact that it's very unlikely that the Fed is going to lower rates. The Fed knows that inflation is too high. And besides eggs, right? Eggs are the big one that a lot of people have been talking about. Eggs are up 15% over the last few weeks. The Fed's looking at that, of course, but a lot of that had to do with the bird flu, but they're looking at other indexes as well. But of course, food prices do have a big indication to the Fed of saying, okay, food prices are going up besides just eggs, which food prices have gone up, whether you've noticed it or not, outside of buying eggs or going to the store and not even being able to find eggs because there was such an egg shortage. But these are just all indications and numbers that the Fed is looking at. And when they're not feeling comfortable with the numbers that they're seeing, they're not going to react quickly. And again, I was very surprised last year about them cutting rates as aggressively as they did, because I do agree with Fed Chair Jerome Powell that there is more work to do. We have been in a very long, sticky inflationary environment. And unfortunately, until the numbers are back under control a little bit more, we're going to continue to remain in this environment of elevated interest rates. And the Fed is not going to make any indication that they will continue to lower rates anytime soon. So just a lot of numbers to really monitor on that side. The good news behind this, again, is really the fact that U.S. companies are doing so well. And despite inflation being persistent and the Fed being so in terms of managing inflation rates and such, the U.S. economy is doing really well. And that's the most important thing. When the U.S. economy is doing well, when the labor market looks strong, it gives us very high confidence as financial planners and analysts and even consumers and investors alike that a recession is just not going to happen. And of course, that's not guaranteed. Of course, we don't know what the future is going to look like. I don't have a crystal ball to tell us what's going to happen 6 months from now, 12 months from now, of course, but it gives us very, very good indicators that a recession chances is low. Let's talk a little bit about some of the tariffs now, because tariffs have really been the hot take. We've talked a lot about them already, but they keep coming to light in the media because Trump keeps trying to push the tariff agenda. So again, whether or not you are a fan of his policy or not a fan of his policy, the fact of the matter is that tariffs are becoming more regular conversation, and they may or may not have an impact on us as investors. So let's break it down a little bit and what that means. Trump recently has said he wants to implement tariffs on a lot of commodities, specifically metals, aluminum, copper, gold, silver, and it definitely can reduce some companies that rely on metals. Think of like maybe car manufacturers, think of electronics producers, think of really any business that might have a metal component that they might need. And again, this could be something as simple as maybe like an appliance maker, right? Someone who makes ovens, stoves, metal spatulas, frying pans, things like that. These companies can all be affected by those tariffs. So it's just something in mind when we're looking at what investments to consider and where to shift portfolios around. We may want to maybe taper out some companies that might be affected by this risk. The one metal that Trump has wanted to add a tariff on that has done really well despite everything else going on is gold. Gold did really, really well last year. It was up about 25%, which for a precious metal is high in any given year. And gold has continued to rise to start off 2025. So it's funny that the risk of a tariff on gold, people might think that the price of gold will go down, but that's not actually the case. Tariffs actually could weaken the dollar a little bit on an international level. And when that happens, foreign banks will tend to swap U.S. currency that they're holding in favor of gold. So if they feel that their investment in the U.S. dollar, I mean, they literally own physical bills. So what they'll do is they will offload these bills. They might send them back to the United States. They will go out. They will purchase gold bullion, and that's going to drive up the demand of gold, because if they're buying lots of gold, then of course the demand is high. When the demand is high, the price will go up, right? It's basic economics. And last year alone, foreign banks bought over 1,000 metric tons of gold, and this was somewhat record-breaking. This has never really happened before. So we're seeing foreign banks really, really stockpile their gold supplies, and that's really what's elevating gold prices. So this is not me saying let's all rush and go buy gold, right? It's not me saying let's go make a crazy investment into a gold fund or a gold index, but it's something to be very mindful of. Introducing alternative investments into portfolios such as commodities and things like that can actually help create really good diversification. So even if we introduce maybe, or someone says, I'm interested in introducing some commodities into my portfolio, maybe a 3 to 7% exposure could be somewhat of a healthy thing to create diversification. It creates some growth opportunities, especially in the rate environment or the growth rate environment that we're seeing with gold. So again, this is not me recommending that that's the allocation that someone needs. I'm just sort of throwing out a low allocation percentage as an idea. If anyone was considering this or just had some questions on it and said, hey, Ben, I know gold has been really rising over the last year and I want to add some gold exposure into my portfolio. What's sort of the right balance before I overexpose myself and take too much risk in gold or have too much of a concentration in gold, and then all of a sudden gold tanks and I'm left in the dust, right? So those are all really important aspects to consider when introducing new investments into your portfolio or creating a higher concentrations of pre-existing investments you already have. So with that in mind, I just want to talk a little bit about some tax tips as we wrap up. So a lot of us have been receiving our 1099s already. So please make sure you're getting them to your appropriate person, whether it's a H&R Block service that you use. If you're self-preparing on TurboTax, make sure you start to file them over there. If you're using a preparer such as Advisor Tax Prep, which is us, or an outside tax preparing firm, be sure to start sending them over to them in a timely fashion so they can start to prepare your returns. If you are also thinking about doing any prior year retirement contributions, you do have up until your filing date or April 15th to complete those contributions for 2024. And again, as a reminder, the limits in 2024, if you're under the age of 50, it's $7,000 per person, right? So a husband and wife, a spouse can contribute $7,000 each. And if you're above age 50, you can contribute an additional $1,000 more. So $8,000 each per spouse. So again, if this is something that you had maybe thought about, but you weren't sure where your income was going to be by the end of the year, if you thought I'm going to be right at maybe the adjusted gross income phase out limit, so I held off, but now you know what your numbers are because all of them have come in at this point. Definitely take advantage of contributing to your 2024 retirement accounts. Every little bit you can save helps. So thank you so much for tuning in today. And I look forward to seeing everyone next week. And we're going to talk more about Q4 earnings reports because hopefully at that point, the rest of the S&P 500 companies will have reported. And we'll be able to talk a little bit more about inflation, assuming that Jerome Powell gives us some more indication of what's on the horizon for him. So again, thank you for tuning in today, and I'll see everyone next week.